The great and the good of the global reinsurance industry are gathering in Monte Carlo for the annual Rendez-Vous de Septembre. And as ever, there's plenty on the agenda. I'm Richard Banks with AM Best TV. And I'm joined now by Bob Quane, Chief Underwriting Officer at Beazley. Bob, welcome.
Thank you, Richard. I'm glad to be here.
So, Bob, we're hearing a lot about reinsurers' risk appetite, underwriters being a little bit more discerning about the lines that they want to write. What are the main factors at play?
Yeah, well, I think on the property side, I don't think people have shied away from it, but there clearly has been a capacity crunch. And the increase in demand has outstripped the supply, and that was really driven by inflation and, of course, climate change. But I think there's been some horse trading as a result. So we had reinsurers using their property capacity to get other business on the casualty side that they desired to have a diverse portfolio. But, for us, we grew 65% in property, and we do have a reinsurance property book within that. So we were leaning into the property opportunity. And we were able to do that because we made several investments into climate change to make sure that we were prepared to make the right decisions on different climate property risk.
Tell us a little bit about that. So, investments into climate change. What are the sorts of things that you're talking about there?
Well, the big investments we made first into property pricing actuaries to make sure that we had a granular level of pricing, particularly of the secondary perils, which weren't as focused on before. And wildfire is a great example. Climate change has made that a more meaningful peril. And so we're, increasing our intellectual capacity on that. We've also strengthened our exposure management teams. And we also hired a head of climate risk. And this person works very closely with the exposure management team, and they're making sure that our models are adjusted for climate change, our CAP models. So that's all very important. We do think all of this is helping to de-commoditize property, which we think plays to Beazley's strength and makes it more of a specialty product.
So if you're decommoditizing property, how does that impact the rest of the portfolio? How does that impact the market more generally?
Well, for Beazley, it's been a good thing because we in recent years, I think we navigated through the soft market more than others. And I do think it's a strength of Beazley. So we weren't filled up on property exposure. So we were well positioned when the market hardened. And we really want to grow our cyber books and other products, and we need to be a diversified company. So we welcome the opportunity for property to be more appropriately priced so that we can grow in that area and maintain a diverse book across the entire company.
A couple of things to talk about there, very interesting. So you talked about navigating the soft market. Clearly, all the talk seems to be that we are in if not a hard market, a market that has hardened dramatically. There was some discussion last year at Monte Carlo about the lack of experience of underwriters in terms of managing a genuine hard market. How do you think the market has coped with the conditions that it's seen over the last 12, 18 months?
So first of all, I do think most products are in a hard market, but unfortunately not all of them, at least not for the insurers. So there are some products that are in a soft market today. But in terms of the hard market, you're right. There are some junior underwriters that haven't had experience with this. But fortunately, Beazley, we do have a large bench of seasoned underwriters, and they've seen every angle of the cycle and have a lot of experience of how to deal with the market, with clients, with brokers, and they are coaching our junior underwriters to make sure they're prepared and are behaving correctly in this difficult market. And also, it's not just junior underwriters. You have junior brokers, and they also have to be educated. And sometimes we're the ones that have to do that educating to make sure they understand that it's a different situation when you're in a hard market. And we're not trying to take advantage of anyone, of our clients, anything like that. But it's hardening for a reason. And we just need to make sure that our underwriters are doing the right thing.
So hard markets typically last less time than a soft market. How does one go about, if not prolonging the hard market, at least making sure it doesn't end prematurely?
Well, I think part of it is not overreacting to it. You have to be fair. And I think most of us would prefer a stable market for the entire cycle and not have these volatile swings up or down. I don't think that's in the interest of insurers or clients or even brokers. So, to the extent that we can all behave in a stable way, will help. And so I do think people have memories, so you don't want to overreact. You want to behave appropriately, not gouge anyone, for example. And the more you do the right thing, I think the longer the market lasts. And it's with deep, with more shallow troughs and high points. And I think that's best for everyone.
Can we talk about a particular line of business? And it's one I think that Beazley has attached its name to, cyber. I guess it's been one of the beneficiaries of the changing risk appetite. Can you tell us a little bit about how you approach cyber, and particularly about risk of accumulation, because that seems to me to be a particular concern.
Yeah, so cyber, of course, it's an incredibly growing line. This year it's grown less than the past two, but we do believe it's going to grow to at least 30 billion. And there's different numbers out there right now. I don't know the exact number, but I guess it's about 12 billion today. So we want to make sure that this is a sustainable product as it grows. To a huge size. So there's two big things that we've done recently to address that. One is we've updated our cyber war wording. It was more than just war, though. War is what's talked about the most, but we've updated that to address, the recent, the modern situation that we have today. The old exclusion just wasn't appropriate, and so we needed to tighten that. But we also updated our infrastructure exclusion, and we also added sublimits for our smaller clients, I would say, because of accumulation. And there's a lot more smaller clients than there are large clients. So we had sublimits for large cat exposures, cyber cat exposure. And, that last point, having a sublimit is very similar to the property market. We have sublimits for hurricanes and sublimits for earthquake. And so we're approaching it in the same way just for cyber. So that's what we've done to make sure it's sustainable. We want to make sure it's a product that we can manage appropriately with risk appetite and aggregations, as you mentioned. The other thing that we've done is we've wrote the first cyber cat bond this year, and we think that's very important because as this market grows, we do not believe that the traditional reinsurance has enough capacity to support all that growth and all the aggregation that we're seeing. So for the primary companies to retain an appropriate risk appetite, we really need, additional avenues to address our reinsurance needs. So we did that this year, and as of August 1st, we were able to raise $81 million, and that was not a price play. This was all about creating this additional option for capacity. So those are the big things we're doing to address the aggregation.
Great, thank you. So finally, then, the reinsurance industry generally appears in reasonable health. Earnings seem to have bounced back, but how sustainable are those earnings, and what does that tell us about how we prepare for the future?
Yeah, on the property side, they have made huge strides, the reinsurance market, and I think they've demonstrated that because they've increased attachment points, and often they've doubled. I mean, they try to move to the 1 in 10 event, and so their attachment points are now above these medium events, which is where they need to be as a reinsurer, and I think that'll make it sustainable for their capacity. And I just don't see any change to that, certainly not in the immediate future, but I really don't think in the long term. We are just seeing, increased frequency of hurricanes. You just had Idalia. It's going to be a smaller event or a medium-sized event, but we just know that next hurricane is looming, and there's one, forming on the Atlantic right now. So I think that's going to keep the discipline. The temperature of the ocean is just unbelievably high and the impact it's having on these events. So because those events are here to stay, I really think it's going to keep reinsurers disciplined, particularly on the property side, and it's going to keep it sustainable.
Well, thank you very much indeed for joining us today.
Richard, thanks for your time.
For more coverage of the Monte Carlo Rendezvous and a host of related insights, visit ambest.com. For AM Best TV, I'm Richard Banks.